The industry term for the customers your bank profits from most is not loyal customers. It is not preferred clients. The internal language, the language that appears in branch performance dashboards and contribution margin reports, is high engagement accounts. High engagement is banking industry shorthand for this person pays us the most. They are not your wealthiest customers. They are your most extractable ones. And the specific dollar amount that separates those two categories, the number that breaks the extraction model entirely, is $10,000. By the end of this video, you are going to know 5 specific mechanisms your bank runs on customers below that threshold, why crossing it disables all 5 simultaneously, and what the math actually looks like on the other side. The Federal Reserve's 2024 survey of household economics and decision-making found that 45% of American adults do not have enough set aside to cover 3 months of expenses. For household spending somewhere between $3,000 and $3,500 a month, which tracks with median American household spending 3 months of coverage, requires roughly $9,000 to $11,000. That is the threshold at which the recurring extraction model starts to break down. Below it, 5 separate revenue mechanisms function against your account every single month. Above it, most of them stop functioning entirely. I want to give you one metaphor before we go into the mechanisms, because it will make every subsequent point land faster. Think of your bank as a toll road, not a modern, publicly accountable government highway. The old kind, 1800s, private company, only bridge over the river. They set whatever price they wanted because your alternative was swimming. The toll road owner did not need you wealthy. Wealthy people had boats. He did not need you to fail completely. Broke people cannot pay any toll. He needed you almost okay, productive enough to keep earning, stretched enough to keep needing the bridge. Every month, reliably, you showed up and paid. $10,000 is when you build your own bridge. The moment you do, the toll road operator loses his pricing power over you permanently. The bridge does not depreciate. It does not expire. You only have to build it once. Hold that image. We are coming back to it after every one of these mechanisms. I want to tell you a story I am going to finish at the end of this video. There was a branch manager, I will call him Derek, who worked at a regional bank in Ohio for 15 years and told me something about how branch performance was measured internally that I've thought about many times since. I am going to give you the setup now and come back to the ending, because the ending changes how you understand the direction this whole system is moving. But not yet. First, the 5 mechanisms. I call them the 5 toll booths. Toll booth 1. In 2024, new estimates show that consumers spent $12.1 billion on overdraft and NSF fees in 2024. $12.1 billion in 1 year from one product line. But the headline number is not where the interesting part lives. The interesting part is the concentration. CFPB data show that roughly 9% of accounts comprise 79% of overdraft and insufficient funds fees. And these consumers overdraft more than 10 times a year. The bank is not casting a wide net hoping to get lucky. It is targeting a precise demographic at a precise level of financial stress. With engineering that has been refined over 3 decades, here is the engineering. When multiple transactions arrive at your account simultaneously, which happens every time a paycheck clears against a background of pending charges, the bank has choices about the processing order. Process small transactions first, and your account has the best chance of absorbing the large one without going negative. Process the largest transaction first, and every smaller pending charge afterward becomes an overdraft. A California federal court found that Wells Fargo had generated $203 million in overdraft fees attributable to its high to low ordering resequencing transactions in the order of highest to lowest in dollar amount to drain customers' accounts as quickly as possible, to artificially increase the number of overdraft occurrences. Bank of America settled similar litigation for $410 million in 2011. JP Morgan Chase promised $162 million in 2013. To date, banks have shelled out $1.1 billion in restitution for overdraft abuses. The practice generated so much revenue that 9-figure legal settlements were priced into the model. Here's the reversal I want you to notice. You think the problem is that the fee is too high. The fee being high is the symptom. The actual problem is the absence of a savings buffer that makes the fee structurally impossible. Eliminate the second problem, and the first one ceases to exist. $10,000 in savings means your checking account never gets close enough to zero for the reordering algorithm to have any moment of entry into your life. The toll booth is simply not on your route. You drive past it every month on the highway you built yourself. In a few minutes, I am going to tell you about a regulatory story involving a rule that tried to fix overdraft pricing, cleared a full review process, was set to take effect in October of 2025, and was then retroactively killed by Congress using a mechanism that now makes it permanently impossible to try again without new legislation. The outcome of that vote will tell you exactly who the system is optimized for. But first, there is a more expensive toll booth that almost nobody talks about in the right terms. Toll booth 2. The credit card industry has a specific word for its best customers. Not its wealthiest customers, not its most loyal ones. The customers who pay their balance in full every month, collect all the reward points, and generate zero interest revenue for the issuer, have a name in trade publications and internal industry documentation. The industry calls those customers deadbeats. That word, deadbeats. The person who uses the product correctly, refuses to be extractable, and will not subsidize anyone's quarterly earnings is the deadbeat. That should be your explicitly stated financial goal. Become the deadbeat. The average APR for all credit card accounts in the first quarter of 2026 was 21%. The latest lending tree data on credit card APR shows that the average APR with a new credit card offer is 23.75%. Americans' total credit card balance is $1.277 trillion. As of the fourth quarter of 2025, according to the latest consumer debt data from the Federal Reserve Bank of New York, the highest balance since they began tracking in 1999. That is a $1.277 trillion balance at roughly 21% interest. The carrying cost on that aggregate balance annually approaches $250 billion per year. The mechanism is not complicated once you see it. 55% of balances cover essentials, groceries, rent, healthcare, not discretionary spending. Without a savings buffer, a $900 car repair becomes a $900 credit card charge at 21%. The balance stays because the emergency consumed the surplus that would have paid it off. The interest compounds month over month. The next emergency arrives before the first one is retired, and the balance grows. The average American cardholder who carries a balance owes approximately $7,886. At 21% APR, that balance costs roughly $1,656 per year in interest. Not reducing the balance, not improving the situation, just the carrying cost of not having had a savings buffer when the first emergency arrived. $10,000 breaks this cycle, not through discipline, but through infrastructure. The car repair comes from savings. The car gets paid at the end of the month. You collect the points. You become the deadbeat, and the toll booth goes dark. A financial advisor at a large regional bank was once asked by a new client to walk through their full investment picture. The client said it was $9,000 in a savings account. The advisor asked about risk tolerance, time horizon, and estate planning considerations for 45 minutes, then made a recommendation for 3 financial products, charging approximately 1% annually. The client quietly calculated that 1% on $9,000 was $90 per year on a portfolio that would earn around $400 annually in a basic high-yield savings account before fees. The advisor said, building wealth is a long-term process. The client thanked him, paid the consultation fee, and opened a high-yield savings account at a different institution when he got home. The toll road does have very well-dressed attendants. By the way, hit subscribe if you enjoy this content. YouTube's algorithm runs on specific inputs, and one of them is that you subscribe. If you do not, there is a genuine mathematical chance it never shows you one of these videos again. Not a scare tactic, a delivery system mechanic. Now, here is the third toll booth, and it is the one I think about most because it is the one that operates without any billing statement. It is invisible, it is measurable, and it explains why people with low savings often make financial decisions that compound the problem rather than resolve it. In 2013, researchers Anandi Mani, Senthil Mullainathan, Eldar Shafir, and Jiaying Zhao published a paper in the journal Science, measuring what financial stress does to cognitive function. Their study revealed that simply raising monetary concerns for the poor erodes cognitive performance even more than being seriously sleep deprived. Because the Ravens test is used to measure fluid intelligence, it has a direct analog with IQ. Their effects correspond to between 13 and 14 IQ points. Losing 13 points can take someone from average to a category labeled borderline deficient. These differences are not between poor people and rich people. Rather, they document how the same person performs under different circumstances. The same person has fewer IQ points when preoccupied by scarcity than when not. For context, one full night without sleep impairs cognitive function by approximately 8 IQ points. Chronic financial stress is cognitively more damaging than serious sleep deprivation. And unlike sleep deprivation, it does not resolve with a good night's rest. It runs in the background continuously, consuming mental bandwidth that would otherwise be available for reasoning about financial decisions. The practical consequences are specific and measurable. Under financial stress, people are significantly more susceptible to impulsive purchases because buying something produces a short-term neurological relief from the discomfort of scarcity. Scarcity reduces mental bandwidth. That reduction means you have less capacity available for comparison shopping, for holding firm in a negotiation, for reading the fine print on a loan offer. Urgency-based marketing also hits harder when you are already operating from a scarcity baseline. Limited time offer activates a scarcity response in someone who is already in a scarcity state. The companies extracting the most margin from financially stressed customers did not manufacture the stress. They priced their products around its presence. That is a meaningful ethical distinction. The financial outcome is identical either way. $10,000 is approximately the savings level at which this chronic cognitive degradation becomes manageable, not eliminated, manageable for most American households. The 13 points return, with them comes the capacity to slow down, compare options, walk away from a deal that is not right, and think about next month rather than next Tuesday. That is the actual value of the number, not security, reasoning capacity. This is where the leverage story extends beyond the bank. Stay with me because this is the part that compounds on everything I have already said, and it connects to a practical outcome you can measure in salary terms. Let me tell you about a woman I will call Claire. Claire worked in marketing for 8 years at a mid-sized company in Atlanta. Capable, well-regarded by clients, consistently documented as a contributor, her manager, charitably described as exhausting, consistently appropriated her work in senior presentations, passed her over for 2 promotions she had documented cases for, and dismissed her ideas in meetings before deploying them privately a week later. Claire saw this clearly. She was not passive. She filed a formal written complaint with HR after the 2nd promotion she was passed over for. Nothing changed. She kept showing up every day, not because she lacked the clarity to see the dynamic, because she had $5,000 in savings, a mortgage, and a young child in daycare. The arithmetic did not produce any other viable conclusion. Her manager had leverage over her, not contractual leverage, the leverage of knowing she could not afford to test him. Then Claire's aunt died and left her $15,000. She added it to what she had, roughly $20,000 total. Within 90 days, she had applied to 3 companies, received 2 offers, and resigned. Her exit conversation generated a counteroffer 23% above her current salary. She declined it because the incoming position was better structured. None of this required a different version of Claire. She did not develop new courage in 90 days. She became non-desperate, and non-desperation has a measurable market value. Behavioral economists call what Claire experienced outside option value, the value of a credible exit, not a theoretical one. Below $10,000, any claim of "I could walk away" is a structural bluff. The person on the other side of the table often senses this, even when neither party has articulated it, and they price their offer to reflect it. Above $10,000, the option is real. Real changes the entire posture of every negotiation you are, inside the annual review, the lease renewal, the conversation about the promotion timeline, the contractor who knows you need this done by Friday. The critical word, always, is credible. Here's the part that knowing these numbers does not automatically solve, and it is the honest reason I built something to address it. Knowing that a savings buffer changes your negotiating leverage, your cognitive function, and your extraction profile is one thing. Building the actual system around it, the withdrawal framework, the tax-efficient sequence, the infrastructure that converts I understand this intellectually into a specific date on a calendar is a different exercise entirely. I put together a digital book called The Exit Code. It is built on 50 years of actual retirement data, not opinion. Two things in it connect directly to what I have been describing in this video. The first is the dynamic withdrawal method, a replacement for the 4% rule that most financial planners still use, which has a documented failure rate in sequence of return scenarios that almost nobody explains clearly in plain language. The second is the lazy portfolio, a specific allocation strategy with a 30-year performance track record that has consistently outperformed active management built precisely for people who do not want to spend their lives reading earnings reports. Knowing that a savings buffer changes your posture is useful. Knowing the specific sequence buffer first, then deploy, then withdraw, in the right order with the right math behind it, is what turns useful knowledge into an actual plan. The exit code is available through the link in the description for less than what you would spend on a dinner out. Every year you delay building the system is a year the math compounds against you instead of for you. Now, Toll Booth 4, and this is the one that tells you something specific about who the system is designed to serve. In December of 2024, the Consumer Financial Protection Bureau finalized a rule that would have capped overdraft fees at $5 for large banks, specifically those with more than $10 billion in assets, which accounts for the majority of the $12.1 billion annual extraction. The rule would have taken effect October 2025. However, Congress overturned the rule using the fast-track procedures of the Congressional Review Act through the passage of S.J. Res. 18, which the President signed into law. Under the Congressional Review Act, the CFPB cannot issue a substantially similar rule without new legislation. The door is not just closed, it is legislatively sealed until Congress decides to open it. The banking lobby's stated argument against the rule was that capping overdraft fees would reduce access to liquidity for consumers who need it most, implying that without a $35 fee, banks would stop covering overdrafts entirely. From 2020 to 2023, research from the CFPB found that banks had reduced their revenue from overdraft and non-sufficient fund fees by nearly 50% when voluntary policy changes took effect. During that period, customers did not shift to payday loans in elevated numbers. The argument was empirically testable. The data did not support it. The argument prevailed anyway. I find this more funny than enraging. The correct emotional register is amused disappointment, but the vote tells you precisely who the regulatory environment has been optimized for. And it tells you that waiting for a regulatory solution to the problem I have been describing is not a productive strategy. The bridge you build yourself is the only infrastructure you actually control. Toll Booth 5 is the quietest of the five. It does not appear on any statement. A body of National Bureau of Economic Research analysis documents that borrowers under measurable financial stress pay between 1 and 2 percentage points more on loan products than financially stable borrowers with comparable credit scores. Not because they are riskier borrowers, because they are less capable of walking away from an offer. Lenders detect this. The awareness is priced in, silently. 2 extra percentage points on a $25,000 car loan over 60 months costs approximately $1,400 over the life of the loan. 2 extra percentage points on a $300,000 mortgage over 30 years costs in the range of $42,000. These are the tolls paid without a receipt, the desperation premium, the price of needing this to work out today on their terms, because you cannot afford to say, let me think about it and mean it. $10,000 eliminates it. Not because you become a more creditworthy borrower, your credit score may not move at all when you cross the threshold, because you become a less captive one. The lender loses the ability to price in your need for immediate approval, because you now have the genuine option to walk and come back next month. The bridge changes every negotiation, including the ones that do not look like negotiations. Let me now run through a realistic scenario with specific numbers, because I have spent too many years reading financial content that becomes deliberately vague the moment the math gets uncomfortable. Marcus is 38 years old. He earns $64,000 a year after taxes, roughly $4,300 a month in take home. His fixed monthly expenses run about $3,000. Food and gas at around $400. On a good month, he clears $900. On a bad month, he is flat or slightly negative. He has $1,800 in savings, which has essentially been $1,800 for 2 years. Every time he accumulates meaningful progress, an unexpected expense consumes it. He rebuilt twice, got hit twice. The third time, Marcus does one structural thing differently. He opens a high-yield savings account at a separate institution from his primary bank. Different app, different login, different institution. High-yield savings accounts yield up to 5% APY as of May 2026, compared to the national average savings rate of 0.3 to 8% from the FDIC. He sets up an automatic transfer of $400 on the exact day his paycheck lands, before he has had any opportunity to see the money and mentally allocate it elsewhere. Not variable, not whatever is left at the end of the month. A fixed, recurring, automatic payment to himself, treated exactly like a utility bill. Month 1 through month 14. Marcus goes from $1,800 to $9,400 net of one mechanical breakdown, costing $800 that he rebuilt from over 3 months. Not a perfect run. The system did not require a perfect run. It absorbed the disruption and continued. Month 16. Marcus crosses $10,000. Here is what changes in the following 60 days. His credit card utilization, which had been running at 38% because he was using cards as a buffer between paychecks, drops to 11% as his checking account float eliminates the need to charge routine expenses. His credit score increases 27 points. He refinances his car loan. At the new score, the rate drops 1.8 percentage points. Over the remaining 29 months on the loan, that saves him approximately $900 from one 20-minute phone call. That required a $10,000 savings account to make possible. He switches his car insurance to a higher deductible because he can now actually cover it if needed. The premium drops $54 a month, $648 a year. He did not change his driving behavior. He changed his financial posture, and the posture changed the price. 7 months after crossing the threshold, Marcus is saving $650 a month instead of $400 because the downstream effects of the threshold have eliminated recurring costs that were previously invisible. He did not get a raise. The leverage of the number did the work. Now, let me close Derek's story, because the ending is worth more than the setup. Starting around 2021, as several major banks voluntarily reduced or eliminated overdraft fees following regulatory pressure. Citigroup and Capital One eliminated overdraft and non-sufficient funds fees entirely. Bank of America capped its fee and restricted eligible transaction types. Derek's regional institution made a similar internal pivot. Branches that had been deeply reliant on high engagement account revenue saw their contribution margins deteriorate. The quarterly metrics that had made those branches look productive for years started to look fragile. Derek's branch was in the other category. His customer base had higher average savings balances. A meaningful share held above $10,000 in liquid savings. His branch had been considered slightly below expectation on fee-based metrics for years because his customers simply did not overdraft or revolve balances at the rates the earnings model was built around. After the industry shift, Derek's branch looked exceptional. His customers were still there, still depositing, still opening mortgage products and investment accounts and referring their adult children as new customers. The lifetime value per account at his branch was substantially higher than at the high engagement branches. It had always been that way. The measurement system had just been optimized for quarterly fees rather than decade-spanning relationships. So nobody noticed until the quarterly fees disappeared elsewhere. Derek got promoted. Not through any particular foresight, because the demographic reality of his branch had accidentally been running the correct long-term business model the entire time. Here is what his story tells you about the direction of travel. The customer above $10,000 in savings is worth more to a bank over 15 years than the customer below it who generates monthly fees. The industry built its earning structure on the latter. The actual franchise value of the business lives with the former. The toll road company eventually discovered that its most durable revenue was not the toll. It was the customer who built their own bridge, crossed it, and kept living nearby. 3 specific actions for this week, calibrated precisely to everything I have described. Not generic, not applicable to every financial video on the internet, specific to this threshold and these mechanisms. First, calculate what I call your extraction rate for the last 12 months. Pull your statements, add every overdraft fee, add every monthly maintenance fee your checking account incurred, add every dollar of credit card interest paid over the period, add a rough estimate of the loan rate premium you have paid across any active installment debt from negotiating without a credible exit. For most people below $10,000 in savings, this total lands somewhere between $1,200 and $3,000 per year. That is not principal being paid down. That is not an investment in anything. That is the annual cost of being below the threshold. Write it down. That number is the specific financial case for crossing to the other side. Second, open a high-yield savings account at a different institution from your primary checking account. Different app, different login, different institution entirely. High-yield savings accounts currently yield up to 5% APY, compared to a national average savings rate of 0.3 to 8%. On $10,000 over 1 year, that gap represents the difference between roughly $500 in earned interest and $38. $460 of real money lost to inertia. The institutional separation also creates friction between your savings and your checking balance. That friction is the entire point. When savings are one tap away in the same app as your checking account, the psychological barrier to an impulsive withdrawal is approximately 0. A separate institution with a 2 to 3 day transfer window often provides exactly the pause needed to prevent the decision that would reset your progress by 6 months. Third, set up an automatic transfer from your checking account to that high-yield savings account on the exact day your paycheck clears. Specific dollar amount, non-negotiable. Not whatever is left at the end of the month, because that number varies every month and frequently arrives as 0. Treat it as a fixed obligation, the same category as rent, the same execution priority as your car payment that happens before you've had any opportunity to see the money and mentally earmark it for something else. The system does not require every month to be perfect. It requires a default structure that absorbs the imperfect months and keeps running. Here's what I want to say plainly before I close, because most financial content will not say it in these terms. The financial advice industry is structurally optimized around complexity. The more products you hold, the more strategies you believe you need, the more active management you are convinced is necessary, the more billable activity exists for the industry. A financial advisor who told every client get to $10,000 in a high-yield savings account, then deploy everything above that threshold into a low-cost total market index fund and leave it entirely alone for 20 or 30 years would be giving you mathematically correct advice and would have essentially nothing to charge for next quarter. So that advice does not get delivered as the default recommendation. What gets delivered is allocation frameworks, rebalancing schedules, alternative asset diversification, and the sustained theater of active management justifying an annual fee on a portfolio that would compound more effectively without the intervention. I have spent more than 10 years running a business surrounded by accountants and tax attorneys who explained in very specific terms how money actually moves when the fee structures are visible. I have several $100,000 invested. The pattern that holds across real people and real situations over time is not cryptocurrency, is not option strategies, is not the next platform promising asymmetric returns through an algorithm. It is the boring, compounding, patient process that starts with one threshold. The S&P 500 has averaged roughly 10% annually over the last 30 years. Nominal. $100,000 invested at age 35, left completely untouched until age 65 with zero additional contributions, compounds to approximately $1.7 million. Not from genius, not from market timing, not from reading 5 financial newsletters a week, from compounding and patience. Patience is only genuinely available to you once you have crossed the savings threshold, and the next unexpected car repair is no longer a financial crisis waiting to happen. The sequence matters. The bridge comes first. Lazy investing built more fortune than crypto memes. The toll road is still out there. Patient, fully staffed, optimized by decades of behavioral data about exactly how people in your income range respond to financial pressure. Its regulatory protections were just renewed by Congress. It has a great quarter ahead. Your job is not complicated. Build the bridge, cross it exactly once, and never think about the toll.